The FTSE 100 suffered a sharp fall today after key details from Chancellor Rachel Reeves' upcoming budget were accidentally leaked by the Office for Budget Responsibility, OBR. In what has been described as a major blunder, the early forecast revealed weaker than expected economic growth for the UK over the next 4 years, along with confirmation that Reeves plans to raise taxes by up to £26 billion in 2029 to 30 through the continued freeze on personal tax thresholds and a range of smaller fiscal measures. Markets reacted immediately. The FTSE 100 fell 0.033% to 9,606.25 shortly before midday following the leak, and dropped further to 0.16% by 12:30 p.m. Sterling also weakened, sliding 0.2% to $1.31 against the dollar and 0.3% to 1.13 euros. The drop comes just hours after the index had opened in positive territory on Wednesday, boosted by banking stocks amid reports that the financial sector would be spared any major tax rises in Reeves' budget. The FTSE had closed the previous session up 74.62 points, or 0.8%, at 9,609.53. However, sentiment shifted decisively once the leaked OBR forecast became public. It revealed that government debt is expected to rise from 95% of GDP this year to 96.1% by the end of the decade, and that the UK's 2026 growth forecast has been downgraded from 1.9% to 1.4%. Budget announcements often influence financial markets, with investors closely monitoring potential tax and spending decisions. The pound and gilt markets are typically the most sensitive to budget policy. Following the leak, government borrowing costs increased sharply. Yields on 30-year gilts jumped 7 basis points to 5.39%, while 10-year gilt yields rose by 3 basis points to 4.53%. Gilt yields, which rise as prices fall, had already been edging higher earlier in the week, though they remain significantly below levels seen earlier this year as interest rates continue to drift lower. Both sterling and gilt prices tend to respond positively to cautious spending plans and minimal tax changes, particularly when investors believe that heavier taxation could weaken economic growth or deter future investment. While the FTSE 100 and other UK stock indices are not always directly affected by domestic policy moves due to the international nature of many listed companies, they remain vulnerable to sharp fluctuations in the pound and wider market sentiment. Thanks for watching. Don't forget to subscribe, like, share, and leave your thoughts in the comments. Your support means a lot.